Hi students, this is Mr. Jason, and I'm going to be talking about ratio analysis, which is one of the topics in Unit 4. So the objectives of this lesson is really to go through the 5 types of ratios and then to learn how to calculate them as well as how we interpret them. So there are 5 kinds of ratios. The first one we will talk about would be liquidity ratios, and liquidity ratios are ratios that measure the company's ability to pay its short-term obligations or debts when it's due. So we will look at short-term debts for liquidity ratios, and for the second ratios it is profitability ratios, and this is to measure the company's ability to generate profit from its operation. The third ratio we will learn about would be stability ratios. This is to measure the extent of the company's reliance on external borrowings to fund its operation. The fourth ratios we will learn would be market ratios. This is really a ratio that is catered to investors because investors want to understand how to value the company. And last but not least, the fifth ratio would be efficiency ratios, and this is to measure how well the company uses its assets in its operation and also how well they manage their liabilities. So when you look at the specifications booklet, which is provided in all major assessments, you would be able to see this table, and this table contains all ratios. So in terms of memorizing, you don't have to memorize the formula, but you will need to know how to apply this formula in calculation questions. So for liquidity ratios, like I said, it is to measure the ability to pay short-term debt. And there are 2 liquidity ratios. The first one is working capital or current ratio. And in your formula booklet, the method of calculating it is to take current assets divided by current liabilities. The second ratio, which is quick asset ratio, it's very similar in terms of the calculation, but you notice that instead of just totaling up all current assets, they will exclude inventory and prepayments, and this is because they are considered not to be very liquid. Because quick asset ratio, it is to calculate very, very short-term debt in terms of whether they are able to pay their near short-term debt or not. So that is for current assets. For current liabilities, they will exclude bank overdraft. Again, this is because bank overdraft is an obligation which you can afford to hold on to even though it is short-term. So they are excluding that on that basis. But both of these ratios are to calculate or to measure the ability to pay short-term debts. Now, if you look at the working capital ratio a little bit more, in the current asset ratio, you can see that accounts receivable is a current asset, but you must take the net amount, which is accounts receivable after minusing allowance for doubtful debt. Most students might just take the accounts receivable without minusing allowance for doubtful debt. You must net the amount. Now, how do we interpret this ratio? If the current ratio or the working capital ratio is less than 100% or less than 1:1, then the reason is, as you can read there, the company only has, let's say, 99 cents of current assets to pay every $1 current liability that the company owes, and the business may be experiencing difficulty in paying its short-term debt. But for retailing industry, they may have less than 100% current ratio because they may be able to attain longer credit term from credit suppliers while they sell by cash, which means that your accounts receivable will be lesser compared to your accounts payable. And retailers also, they usually have efficient inventory management because they keep their inventory levels low. Now, if the business has a working capital ratio of between 100 to 200%, then the business is deemed to have enough current assets to pay its current liability. So this is really the the working capital ratio that the businesses should be looking towards. But ideally, the business should have a current ratio of 200%. This means that after paying $1 current assets for every $1 current liability, the business still has current assets to pay for other expenses because the ratio is 2 to 1. If the ratio is more than 200%, then it means that the business can comfortably pay its short-term debts, but it can also mean that the business has an excessive level of current assets and they may not be making the best use of their resources to generate income. So just remember that when we interpret ratios, for example, working capital and current ratio, we must always compare with industry average or even past years to assess if the company is doing better. Now, the second ratio for liquidity, like I said, is quick asset ratio. So if you are to interpret this ratio, it is really to ensure that the business has a ratio of more than 100%, because if it is less than 100%, it means that in emergency, without relying on inventory or prepayments, the business is experiencing difficulty in paying its short-term debts when it is due. Now again, retailing industry, they may have less than 100% quick asset ratio because the inventory may make up a large proportion, and if you don't include inventory in the calculation, obviously your current asset will be much lower. But if it is more than 100%, then it is able to pay its very short-term debts, emergency debts, when they're due. Again, you must compare this with industry average. Moving on to the second kind of ratio, profitability ratio. So in the formula booklet, the specifications booklet gives you 3 different ratios: profit ratio, rate of return on assets ratio, and times interest earned ratio. Let's go to the first ratio, which is profit ratio. So profit means after income tax. Please remember that it is after income tax, not before, and then you must divide it by total revenue. If you want to get a percentage, then you must multiply this by 100. Now, how do we interpret this ratio? Again, there is no fixed guideline on what number is good, but of course you want the profit ratio to be higher. So as you compare with industry average or even past years, you want to see an increase or a higher ratio. Now, let's say the profit ratio is 30%. That means every dollar of revenue made by the company is able to generate 30 cents profit after tax. When there is an increase in this ratio, it may be due to increase in selling price, increase in demand, better management of operating expenses, or even lower cost of sales because of cheaper supplier. Now, when the profit ratio decreases, it might be due to reducing selling prices because of increased competition. It may be due to a reduced demand. Maybe management of expenses are ineffective, or there can be a higher cost of sales, maybe because suppliers are charging more expensive prices for the products or the materials. The second profitability ratio would be rate of return on assets. So this is profit before income tax. So please note the before and after is very important. So profit before income tax plus with interest expense and then divided by average total assets. Now, why they put in interest expense is to really cancel out the cost of financing. So if you look at the way to interpret this, again, similar to profit ratio, it doesn't have a generic guide on what number is good, but it is always better to have a higher rate of return on assets. And what it means, let's say the rate of return on assets is 30%. It measures how efficient a business is using its assets to generate profits. So if let's say 30% is the answer, it means $1 average of assets owned by the company is able to generate 30 cents profit before tax and interest expenses. Now, of course, companies that are in the manufacturing, telecommunication providers, railroad, airlines industry, they generally have a lower ratio because they need more assets, more non-current assets to generate profit, and therefore it may be more difficult to achieve a higher rate of return because of the higher asset base compared to service-oriented companies which may not have as many assets. Again, you must compare this with industry average. Moving on, times interest earned. So this is profit before income tax plus with interest expense divided by interest expense. Very similar to the previous ratio in terms of the calculation. So there is a guide here. The guide here is between 3 to 4 times. Now, the unit that you use for this ratio is times, not percentage. So what is the meaning of this ratio? It is the number of times of that the interest is able to be covered by the profit before tax, which also means the company's ability to pay interest. So if it is between 3 to 4 times, it is a good safety margin because the company will then be deemed to have the ability to pay its interest because the profit is 3 to 4 times the interest amount. There would be lower financial risk as well when you have higher times interest. And again, compare it with industry average, please. Now, for stability ratios, there's only one ratio here. So it is debt to equity. So for debt to equity ratio, total liabilities, you must add the current and non-current together and then divided by equity. And equity must be the ending equity, not the share capital or the beginning amount, but it must be the total equity at the end of the period. Now, in terms of interpreting this ratio, what this ratio means is the extent of gearing, leverage, borrowings. So please remember these terms because they can call this a gearing ratio or a leverage ratio as well. So it shows the extent of borrowings a company is relying versus equity to finance its operation. So if it is lesser than 40%, usually what it means is that the business is conservative. So this is acceptable because it means that the business is not really relying too much on borrowings, and it's actually very good in terms of recession because the risk of default and insolvency is lower. But if it is above 100%, then the leverage or the gearing is considered high. The business is deemed to be aggressive in financial strategy. Of course, this may not mean bad in itself, but it also means higher interest in loan and higher repayments of loan. So let's say there is a recession when sales is affected, then there would be a risk of default and insolvency. And insolvency just means the business closing down. Again, compare this with industry average because perhaps the industry average itself is more than 100%, so you might be fine. The fourth ratio is called the market ratio, and there are 3 ratios here, so let's look at them one by one. So the first one is earnings per share. This is profit after tax divided by the weighted average number of ordinary shares issued. So you just basically need to weigh the average of the number of ordinary shares issued for the year. So the answer here, the unit is in dollars. Yeah. So again, there is no set guide on what number is correct. But the meaning of this ratio is to really measure how much profit is made per one share that is issued. So, of course, you want EPS to be higher if you are an investor because it just means that there are higher profits reported by the company. And investors like this because higher profits perhaps would mean higher dividends, higher appreciation of share price, which will be good for them. And this is also a consistent consistent indicator of the company's financial performance. Yeah. So again, compare this with industry average. You want it to be higher. Now, the second market ratio is price-earning ratio. So this is market price per share divided by earnings per share. We will only look at ordinary shares, not preference shares in this case. So you need the previous ratio to calculate this ratio. Now, there are a few guidelines here, but let's look at the meaning of this ratio first. So this ratio basically means how many times an investor is willing to pay for each $1 of earnings. And this is referring to the confidence level of the investors in the share of the business. So if let's say the PE ratio is between 0 to 10, again this is in times, yeah. So 0 to 10 times, it just means that the stock is either undervalued, yeah, which means the investors are not valuing it at its actual value, or the company's earnings are thought to be in decline, which means the confidence level is quite low. Now, 10 to 17 is usually a fair value for most businesses. 17 to 25 times mean that the stock is overvalued, or the company's earnings are thought to be on the incline or increased. Yeah, this is called a growth stock because you are having higher confidence in this company, you're expecting it to grow a lot in the future. Now, if it is above 25 times, it may be subject to a speculative bubble because the confidence level of the market is too high, far exceeding the actual value of the shares, and this may be problematic, especially when the bubble bursts. Again, compare this to industry average. The third market ratio here is dividend yield. So dividend yield would be calculated by taking the annual dividend per ordinary share divided by the market price per ordinary share. So the answer will be in percentage. Of course, there's no specific number that is the right number, but of all numbers, you want it to be higher. Yeah, and the meaning of this dividend yield is really the rate of return based on cash dividends if an investor buy at market price now. So if let's say the dividend yield is 8%, it just means that you will get a return of 8% in the form of dividend. And the thing about this is that you must compare it not just with industry average, but also with the rate of return of other investments. Say, for example, fixed deposits, dividend yield of another company, or maybe a bond rates, because you want to invest in the one which gives you the most yield. Yeah, but there's a limitation of dividend yield. It does not take into account capital appreciation. Let's say your share price goes up, or capital depreciation when share price goes down. So you can't just look at the rate of return by looking at dividend yield alone, because sometimes share prices, when it fluctuates, it can also change your rate of return. You want your share prices to be high, right? But you notice that if the share prices are high, then dividend yield might be affected by the calculation from the formula. Alright, in this last type of ratio, which is efficiency, there are two formulas, two ratios to look at: debtors collection and also inventory or stock turnover. So let's look at debtors collection first. So debtors just mean accounts receivable. So it would be average debtors or average accounts receivable divided by net credit sales times 365. So average debtors, you must use the gross debtors, not the net amount. So do not minus these amounts with allowance for doubtful debt. So it will be the beginning amount plus the ending amount divided by 2. Okay, and then you divide it by net credit sales. Net credit sales would be equals to sales minus sales returns minus discount allowed. Yeah, times it with 365 because it is in a number of days. So debtors collection means the number of days it takes for the business to collect from credit customers. This is one of the very few ratios that is better if it's lower, yeah, because it just means that it is faster for the accounts receivable to pay back. So if let's say you have like a higher debtors collection period, it just means that you might have poor debt collection procedures. Maybe you have a slow processing of sales invoices. Maybe you are failing to check the credit ratings of new customers before selling them products or services on credit terms. So this means that it is inefficient, right? But if let's say the debtors collection period is lower or it is low in general, then it means a good thing. Yeah, so the opposite is true. Again, compare this with industry average, please. The second efficiency ratio would be inventory or stock turnover. So this is cost of sales divided by cost of average inventory. So again, average inventory just means the beginning inventory plus ending inventory divided by 2. Yeah, cost of sales would be the cost of sales and then plus any cost related to purchase and then minus the discount received. So inventory turnover, you want it to be higher. If it is increasing or if it is higher, it just means that the number of times in a year is faster for the business to sell off or replenish their inventory. And this is a good thing because it may mean that they're selling popular products. It may mean that you have a less risk of having obsolete or expired products, and it also saves you money on storage costs because you sell quickly. So if let's say the inventory turnover is 15 times, I can actually convert this into days. So how do I convert it? I just take 365 days, which is the number of days in a year, divided by that answer, 15 times. Then I'm going to get 24.33 days. So I can say that the business turns over its inventory 15 times a year, or I can also say that the business turns over its inventory every 24.33 days. It's the same thing. Again, compare this with industry average. But the thing is, if your inventory turnover is too high, then you might have a problem with out of stock because your business keeps selling products too quickly that sometimes you can't restock it on time. So you might lose potential sales. And I think that's it for all your ratios. Just remember, these 5 ratios are something that you are required to know how to calculate. The formulas are given, but you must also know how to interpret each one of them. It's very important. Okay, that's about it. Thank you.